You want to know what are the best stocks to buy now? I've got 4 stocks that I'm buying right now. These stocks have the potential to make millionaires in 2025, and the opportunity is still ripe. If you do not take the decision now, you might miss out on this life-changing opportunity. In this video, we'll cover the latest on these stocks, why analysts are projecting massive buy opportunities, and why these stocks are printing money right now. I have gone ahead and done all the hard work and research for you. All I ask in return is that you hit that like button and subscribe. Remember, the best prescription is a subscription. Now, let's dive right in. The first stock on my radar is Qualcomm Incorporated, ticker symbol Qualcomm. Qualcomm is a global leader in wireless technology and semiconductors, headquartered in San Diego, California. Qualcomm is a leader in 5G technology, providing the tools needed for faster, more reliable wireless communication. Its 5G modems and systems are used in smartphones, IoT devices, and other equipment around the world. The company's Snapdragon processors power many popular smartphones and tablets, combining high performance and energy efficiency. Qualcomm is also a pioneer in modem technology, allowing devices like smartphones and cars to connect to cellular networks, supporting both 4G LTE and 5G. In addition to cellular technology, Qualcomm creates solutions for Wi-Fi, Bluetooth, and GPS to ensure devices stay connected. Its technologies are key in making smart homes, wearables, and connected cars possible with efficient, low-power chips. Qualcomm also plays an important role in the automotive industry, helping power connected cars and self-driving technology. The company operates in 3 main areas: QCT, which designs chips and software for mobile devices, IoT, and cars; QTL, which earns revenue by licensing its wireless patents; and QSI, which focuses on investing in new technologies like AI, virtual reality, and robotics. Qualcomm is well-positioned as a leader in this space. However, as with any investment, there are always risks. One of the primary concerns for Qualcomm is the potential loss of Apple as a customer. If Apple were to replace Qualcomm's technology, which is a possibility, though not certain, it could result in a $7.7 billion revenue impact by FY 2028. Qualcomm's growth in the automotive and Internet of Things, IoT, sectors, including edge computing and cloud technologies, could offset this potential revenue loss. These segments are projected to grow at an impressive 26.6% and 88.1%, respectively, reaching 49% of Qualcomm's total revenue by FY 2028. If these projections hold, they could fully replace the lost revenue from Apple. Additionally, Apple has made similar threats in the past that have not always materialized, meaning there's still a chance Qualcomm retains this revenue stream. From a financial standpoint, Qualcomm remains a highly profitable company, boasting an A+ gross profit margin of 55.9%. While its growth isn't explosive, it is a solid dividend-paying stock with a yield of around 2%. Valuation-wise, it looks attractive, with a non-GAAP forward P/E ratio under 15 and a GAAP forward P/E of 17.53. The stock has a 12.69% gain over the past year, with a 52-week high of $230 and a 52-week low of $148.41. Looking at the technicals, back in June 2024, Qualcomm was trading at $230 per share, and at the time, now, after about 8 months, the stock is available below $175, making it an attractive opportunity. My preferred buy range is between $145 and $162, with a strong buy under $150. At $165 or lower, it's a great candidate for dollar cost averaging, DCA. For long-term investors, even at around $172 per share, Qualcomm stock remains a high-quality company that should compound in a portfolio. This is not a hyper-growth stock. It's a stable, dividend-paying investment. The next stock on the list is Baidu, which is trading under the ticker symbol Baidu. Baidu is a company based in China. I understand that many investors hesitate to put their money into Chinese stocks, but there could be signs of a potential turnaround for those open to the opportunity. China's economy has struggled since the pandemic, but we may see the early stabilization stages. In 2025, the country's economy grew by 5%, low by historical standards, but still a sign of possible recovery. Take Alibaba, BABA, as an example. Following recent developments, its stock has surged nearly 40% as investors regain confidence in China's economic rebound. Now, let's turn back to Baidu. The company has a market capitalization of $26 billion, but its stock has dropped 12% over the past year. Unlike Alibaba, which has rallied, Baidu has yet to participate in any significant recovery. However, just as China hopes for an economic resurgence, Baidu could also be on the verge of a turnaround. Several factors could drive growth for Baidu. Robotaxis, the company is actively expanding in this space. Artificial intelligence partnerships, they have formed strategic alliances, including one with Apple. Strong cash reserves, financial stability provides room for future investments and expansion. That being said, investing in Chinese companies is not for everyone. However, based on 2025 earnings estimates, the stock is currently trading at just 9 times forward earnings, well below its 10-year average of 16 times earnings, making it nearly 50% undervalued. Analysts have set an average 12-month price target of $108, suggesting a potential 15% upside. But this isn't just a short-term play. The latest analyst price targets predict gains of nearly 50% or more. On top of that, billionaire investor David Tepper, who also owns the Carolina Panthers, has been aggressively buying Chinese stocks, showing strong confidence in the region's future. Baidu might present a compelling opportunity for those willing to take on the risk. Next, we're turning our attention to the financial sector, specifically the new age financial sector, where companies like Sofi and Robinhood are reshaping the industry. When investing in financial stocks, one key factor to consider is economic stability. Fortunately, the economy appears to have a solid foundation, with strong consumer activity and a resilient job market. Additionally, interest rates are expected to gradually decline, which will benefit consumers, especially those with variable rate debt. Sofi Technologies currently has a market cap of $16 billion. Over the past year, its stock has surged by an impressive 80%, and in just the last 6 months, shares have skyrocketed by 130%, an incredible run. This stock has gained significant traction among retail investors, particularly those interested in options trading. Since Sofi has a relatively low per-share price, it's often seen as an attractive starting point for traders exploring options. Despite these remarkable gains, Sofi is still trading well below its post-IPO high of $25 per share. Looking at the broader picture, delinquency rates appear to have stabilized, and if they begin to decline, it would be a major positive for Sofi in the coming years. Additionally, as the Federal Reserve lowers interest rates, loan growth is expected to pick up, directly benefiting the company. Sofi continues to expand its customer base, reaching 10.1 million members in Q4, a 34% year-over-year increase. Like many high-growth companies, Sofi recently turned profitable. Therefore, when evaluating its valuation, traditional metrics like the price-to-earnings (PE) ratio may not be the best approach. Instead, price-to-sales provides a more relevant perspective, with the company currently trading at 5x sales. Overall, Sofi remains a strong contender in the evolving financial sector, and as economic conditions improve, the stock could have even more upside potential. The next stock is BigBear.ai Holdings, ticker symbol BBAI, is an advanced technology company specializing in AI-powered decision intelligence solutions. Their technology serves multiple industries, including government and defense, manufacturing, warehouse operations, healthcare, and life sciences. By leveraging artificial intelligence, BigBear.ai helps organizations make data-driven decisions that improve efficiency, security, and operational performance. Recently, the company was awarded a significant 5-year production contract valued at $65 million to support the U.S. Army's Global Force Information Management objective environment. This contract strengthens BigBear.ai's role in national security and highlights its ability to provide mission-critical AI solutions to government agencies. Despite this positive development, the stock has undergone a notable correction, primarily influenced by news regarding the AI model DeepSeek. However, this reaction appears to be an overcorrection. Many industry experts argue that large language models, LLMs, are quickly becoming a commodity, meaning their market value is diminishing as more companies develop similar models. The real competitive edge in AI comes from developing tailored systems that drive real-world applications and sustainable growth, something BigBear.ai has been actively pursuing, much like Palantir. Another crucial factor to consider is BigBear.ai's strong ties to government contracts. Since a large portion of its revenue is derived from government and defense contracts, the emergence of DeepSeek is unlikely to have a significant impact on its business. This presents a potential buying opportunity for investors looking to capitalize on the stock's temporary dip. Examining the company's financials, BigBear.ai has demonstrated steady revenue, though its profit margins have shown some inconsistency. A positive sign is that its debt-to-asset ratio has significantly improved, reflecting better financial health. However, the company has struggled to meet earnings forecasts in recent quarters, which remains a challenge. Despite these fluctuations, analysts still project nearly 20% upside for the stock. Given its current trading price below $10, BigBear.ai could represent an attractive investment opportunity for those looking to gain exposure to the growing AI sector, particularly in government and defense applications. With its proven track record in AI-driven decision intelligence and recent high-value contracts, the company remains well-positioned for long-term growth.